Hello and good evening. Welcome to the Business of Property. I'm your host, Cheryl Leong, and welcome, Property Development Australia members. I hope you're doing well this evening. I'd love to hear who's joining us today because it's a very exciting topic, how to save tax on your property development. I know the property nerds here, if it's anything to do with tax savings, CGT, GST, tonight is the night that all your answers will be answered. Your questions will be answered. And who we have as our guest is Nitin Vashisht from NAV Accountants, who is based in WA, by the way, and they're property tax specialists. So that is a bit of a mouthful, but they're people who actually understand property. So Natin has a very strong industry knowledge and with a very diverse sort of background as both a tax expert and a CFO in the construction and hospitality space. So it is the reason why, we often talk about being able to use someone who understands property. So I'm going to bring Natin down into the room. Natin, how are you doing?
Thanks, Cheryl, and good to speak to you always.
Absolutely. And I know you put together a bit of a presentation for us, which is going to be extremely helpful for our community to understand what are the sorts of tax, considerations to make when they're developing.
Uh,
And I know we're going to be able to go through some case studies as well, which is good.
yes, and I think, Cheryl, the case studies are important because it's obviously a complex topic. And
Yeah.
like I normally say at my talks, is there are two things certain to happen in this world: death
Mm.
and taxes. I can help you with one of these. The
Excellent.
other,
Because
unfortunately, I
because
can't.
yes. So I see that you've got not the medical history, but the property tax history. So excellent.
Correct. And you see, Cheryl, nowhere this death by taxes is sort of more prevalent than in property development, unfortunately. We are going to be seeing a case study later on where, and that is an actual case study for one of my clients. Uh, we had nearly, when we started and the way the project was done and conceived, it was a 62% in terms of tax and GST. He
Mm.
would have ended up paying to ATO 62%. Now,
Ouch.
that is almost giving two-thirds of your hard-earned profits on development to the taxman
Mm.
without them having any skin in the game. And I'm going to just show you an example how we got it down to nearly about 15%. That was a
That's
nearly $100,000 saving in tax. And you know what, Cheryl? That goes straight to your bottom line.
yeah,
That's a
absolutely.
money, that's a money you keep. And that
A-
money is better off with you than with the ATO.
Oh, absolutely. I mean, the thing is that development, people go in thinking, yeah, I'm going to be making a whole lot of profit. They sort of look at they do their feasibility and yep, that's what it says. This is what my target profit
Exactly.
is going to be. And
Exactly.
but if you're not structuring it in the right way, they said there's a whole lot of profit that goes down the drain.
Absolutely. And this is what I always say to the developers. It should be whenever you are counting, doing your feasibility on a development project and your return on investment and your profits, you must count it after tax, not before tax,
Mm.
because otherwise you will not know if you've done something wrong, and if really the tax is going to be too much, what's the point, working really hard for the taxman.
So I know people will have lots of questions. Please pop it in the comments wherever you are on Facebook or LinkedIn. Pop it in the comment section, and we'll leave a little bit of a Q&A at the very end. But definitely, any of your tax or accounting, property development sort of numbers questions, pop it in here. We're going to be going through quite a bit of information here as well. So I'm ready to hit the go button whenever you are.
Now I'm ready. So you want me to pull up my presentation?
Yeah, that would be great. Thank
Yeah,
you.
good stuff. So I will do it now. Are you able to see the presentation, Cheryl?
Yes, perfect.
All righty, guys, good stuff. So let's just get on with the how to save tax on property development very exciting, because if we really do it right, you will realize that you probably can double your ROI, just by saving tax. So you probably will work very hard on the project to make about $100,000-$200,000, and you can very easily add $100,000 by some smart tax strategies. So what are we going to cover? And Cheryl, as we go, just feel free to ask any questions if you see some comments or other questions coming in onto the screen.
Yeah, not a
So,
problem.
so we're going to be talking about the top 3 tax traps in property development. These are the things, Cheryl, that trick people, which we don't normally tend to think, and it comes back to bite us hard. And then we will I think it's really important for, especially if you really are you're a serious developer and wanting to build a property portfolio and active in subdivisions. I think it helps if you really understand a little bit of how the ATO looks at property development and how that tax regime is put together. And don't worry, I've really tried to really simplify it for you in a layman's language. So I'm sure most of you will be able to get it. And another thing, Cheryl, that is very common is people dividing their backyard of their main residence, creating a battle axe. And there are a lot of misconceptions there, Cheryl. People are doing that. They tend to think that their main residence is tax-free. So if they are going to create a battle axe out of it, even that is tax-free. That's not the case. It's your main residence that is free. But if you subdivide it, you create another block out of it, or if you create another unit out of it, now that is not tax-free. And if you really haven't considered those consequences, then you could be up for not only tax, but also GST. So we are going to be covering, and I'll just talk through some strategies, how we can minimize that, or in some cases, look, honestly, even bring it down to zero. And another thing, and this I think is, I get asked it a lot of time, because Australia, we are a migrant nation here, and a lot of us have properties overseas in our native countries where we come from, foreign properties. A lot of people actually don't realize, Cheryl, is that when they sell it, they will be paying tax in that country where the property is. And they will also pay tax on it in Australia, right here. So it's going to be taxed twice. Yeah, it's going to be taxed twice. And obviously there are strategies and things we can do to minimize it, probably in some cases eliminate it, depending upon individual circumstances. But if really we are not careful, we could be paying tax on it twice. And ATO will definitely come to know when you transfer that money into Australia. They definitely are going to be issuing a notice to you to explain where that money is. And if you don't, they will just tax you 49% on that. They will just treat whole of it as income.
That's a really good point. I've got some questions to ask you around there. Excellent. We've already got some questions coming through. Would you like to? I think some of them are talking about discretionary trusts and things like that. So I
We'll
think
come to that.
we'll come to that anyhow. And so let's dive into it. What are the 3 tax traps?
All right, let's get on to the top 3 tax traps. The first one that really trips a lot of people, Cheryl, is GST. So a lot of people, when they're doing, and I'm really talking also of here, a lot of people who, it might be your first project or second project, and a lot of developers are really employed and they have other sources of income and they're just doing it on the side to build a property portfolio. And it's incredible that how many people are under the impression that it's not really their business. They are not covered for GST. They are employed somewhere else. And some are under the misconceptions that since they are doing it in their own name and they are not doing it in a trust or a company, then the GST should not apply to them. Others, plain and simple, don't know GST is applicable to these type of transactions. They think GST is something what they buy off the till, but not on something like this. And guess what? The GST can literally take away 40% of your profits, because it's going to come out of your pocket. The buyer or the market is not going to say that, all right, here is $500,000 for the block or for the unit, and look, here's 10% GST as well. And it is hitting people a lot even harder now because ATO changed the rules around it, and now they expect the buyer to withhold GST
Mm.
and pay to ATO on behalf of the developer. So which basically means is that the moment your block is going to be settled or your unit is going to be settled, the settlement agent is going to be deducting GST and paying it to the ATO.
So say for example, you've got a property that's 400,000 and
Yeah,
you've sold it to a buyer for 400,000. And
correct.
this is a federal regulation.
Yeah, correct.
Okay. So how will that work? Will they'll take away they'll withhold $40,000
Correct.
at
So
settlement?
correct. At settlement, what they will say is that they will ask you whether there should be GST or no GST. Uh, they expect you to check from the accountant, but usually when they know it's just been subdivided and it's a new one,
Mm, mm,
it's pretty. They're pretty sort of hard onto that, and they will just deduct 10%. They'll ask your tax file number and other things, and then just an ABN and remit that 10,000 to ATO. So basically, you're only going to be getting $360,000. And if you think there is no GST or they deducted too much, then that's something your accountant will need to take it up with the ATO.
So do you think that would mean that developers are just going to increase the price to factor in the GST?
No, because the price is a lot of time determined by the market share.
Mm,
I mean, gee, increasing the price by 10% means that property market has to be having a 10% growth. I mean,
yes.
that doesn't even happen,
Mm, mm,
overnight, even in the best of the boom times.
mm,
So basically, it's going to go out of your pocket. What used to
mm,
happen, Cheryl, in the past is it was not been deducted at settlement by
yes.
the buyer settlement agent. So ATO could chase you after that, and it could take many years. And by the time some people will even close the company, or wind it up or declare bankruptcy. So now ATO, because of those reasons, they want it upfront.
And so, I mean, how are we able to um, account for some level of sort of GST offset? Because when you're making, you've got your expenses, and often, there'll be
Yeah, you
expenses
can
that
claim
will
them
have
back.
GST.
You can claim them back. You can claim them back, but you probably are claiming them back your building cost, subdivision cost as you go. Anyway,
Hmm.
if you're registered for
Hmm.
GST.
Hmm. Yeah. So what we're saying is it's important when you're doing your feasibility to
Correct.
ensure that you've factored into it the GST at the end of what you're selling,
Correct.
and
Correct.
also to be able to help with your cash flow as well,
Correct.
claiming back GST
Correct. But
during
I'll
the
come to
project.
some strategies and I'll talk about, how we can probably minimize that. Or in some cases, if you really are structured properly, we can probably avoid that.
Yeah. Okay. Excellent. So
Yeah.
that's GST.
Capital
CGT.
gains, CGT. Now, obviously, there are developers, especially the first time developers, mom and dad
Mm,
getting into it. And some they will think that they probably will they will hold it for 12 months period and they get a 50% discount on capital gains. But guess what? First, if the structure is wrong, then you don't get that 50% capital gains. And in many cases, when you are developing, there is always a risk that ATO will not regard it as an investment, it will regard it as a business. So
mm,
they will deny you a 50% discount on capital gains as well.
mm.
And we will see later on in the case study how it impacts the different things. And the third risk is doing a property development in a wrong structure. So in a wrong structure, that could really expose you to the risk of asset protection or any personal liability might come, but also it can really impact your taxes in a big way.
Excellent. Alrighty. So I hope you're writing and thinking about the sort of questions that you'd like to speak to Natin about next. I mean, structure has been one that comes up all the time. What are the
Yeah,
different types of structures and which are
I
the
will come
ones
to
that are
that.
more
I'll come to
frequent?
that. I'll come to that. But let me just explain, Cheryl,
Oh,
that
okay.
how does the tax on property works?
Mhm,
Or the how will ATO tax you on property? So I'm just trying to simplify a complex topic in a layman's language because it's important that people understand that. Now there are two type of things involved, Cheryl. One, like you were mentioning, what is the type of structure,
mhm,
and what is the nature of the activity you are carrying on. And the difference, Cheryl, is the structure you are in determines the percentage of tax you are going to be paying. For example, a company pays 26% tax. If you really are a trust, you can distribute it to family members who are on a lower tax bracket, and that can really get your average tax on that down. And if you are doing it in your name, then you pay tax based on your marginal rate. So the
mhm,
type of structure determines your asset protection, and it also determines the percentage of tax you will pay. But it is the type or the nature of activity that will determine how the income on which that percentage will be applied is going to be calculated. So how the numbers are going to be added up, what you are going to be allowed as a deduction, what you are not going to be allowed as a deduction, and whether you will be subject to GST or you will not be subject to GST, that will depend on the nature or the type of activity.
mhm,
So really, when we talk of structuring, it's not really just a matter that let's get the structure in terms of trust or a company or combination of it, right? But it is also a matter of getting a clarity and getting it bedded down that what is the nature of activity, and I'll explain a little bit more of it in the next slide. Now, when we say the nature of activity, obviously, from ADO's point of view, you may never have done the property development. You may never do it again, and this might be your first and last property development venture. But from an ATO's point of view, it doesn't matter. They will call it, they've given it some sort of a nice, heavy sounding name called a profit making scheme, and
mhm,
they will still tax you and they will charge you GST as well. And if you're doing it regularly, or if your intention is to make a profit, they will treat it as a business. And the big difference really is how the numbers are added up, that in both, when you are a profit making scheme or a business, you will pay GST, and you will not get this 50% discount on capital gains. So basically what really happens is your return on investment goes down because you're paying a lot more tax.
mhm.
Whereas if you really are an investor, then you get that 50% discount on capital gains, provided you are in the right structure and you don't pay GST. And again, that's a big benefit. So the bottom line, the message I'm trying to give here, Cheryl, is that a lot of people think that getting the structure right is just whether you invest in through a company or a trust or whatever it is. But it
Mhm.
is equally important to really look at it, and I do that with all my clients. That what is the nature of activity, what is it, what they are trying to do, what they are trying to achieve of it, what is their intention, what is their exit strategy, because there are a lot of the subtleties involved, because we need to really balance out both the type of activity and the type of structure to get the best tax outcome.
And with the type of activity, it's something that we've got to get, like you said, embedded into before you even start the project.
Oh,
Um,
exactly, Cheryl. Like normally, what I tell my clients and the people, look, I mean, I can't help you catch the bullet you've already fired, you know,
mm,
but we can always aim right. So we need to. I mean, I do get it that everyone, whether you are an investor or a business or whatever, you are in it to make a quid and to make a portfolio. Fair enough, but there is a subtle difference, and I'll explain that in the next slide. And it is extremely important to understand this distinction, because that basically means is the difference between GST or no GST, a big dollar amount
mhm,
really, Cheryl,
mhm,
and that is the difference between whether you get a capital gain discount or the other tax benefits that are available to an investor or not.
Mm, mm. And so, what happens if you've got a developer who is their intention to begin with has been to build and to sell, and there's been a change in the market, and they decide, okay,
Excellent
I'm
question.
just going to
Excellent
hold it.
question. Excellent question, Cheryl. And let me
I've been
just
doing
come
my
on.
homework.
Let me just come on to the next slide. So this is what it is. What is the nature of the development activity? I think a lot of people probably will understand there's some company or the trust,
Mm,
how it helps, but it is equally important to understand the nature of the activity. And before I come to the question, Cheryl, let me just explain the subtle difference. Like I said, uh, whether you are an investor, whether you are doing it first time and probably the last time, or you're in business, everyone's intention is to make a quid. From ATO's point of view, but their definitions of where you fall are very different from what we might like to think. For example, intention plays, obviously you are mentioning about intention, Cheryl. Intention plays a big part in determining. Now, intention is not what actually is in your mind. I mean, you've got to be able to prove that intention, should it comes to that. And really the intention between a business and an investment is a business person has got really a good clarity when they will exit and they will want. So for example, if you really are doing a project, and once it is done, once your units are done, or once your block is subdivided and ready, you are clear, you want to exit it, and you want to sell it, and you want out. Or and the substantiation to that, what ATO probably will look is that they can see that you have been advertising it. You have been advertising it as you have been subdividing or constructing. So that sort of proves that your intention is to sell it. Means your intention is to get your money back as quickly as you can. Whereas when you are an investor, you are obviously there for a longer period of time. You do not know when you will exit.
mm,
Now, it could happen that something happens and the market goes gangbusters, and you decide to sell it immediately, or you decide to sell it after 1 year or after 2 years. But at the time you started with the project, you didn't know. Now, your circumstances could change later on, and there could be a whole lot of things, Cheryl. I mean, for example, there could be job uncertainty. Someone could lose their job, or there are firings going on in that type of an industry, or you just got an offer that is too good to refuse. A whole lot of things, or your circumstances changed, and you decided to, for valid reasons, reduce your debt and took whatever reasonable offer came your way. So that's fine. So intention can change, but you will still be taxed based on how you went on with the
mm.
development and what was the intention at the time.
Excellent. All
Does that
right.
answer
So,
that question?
yes, it does. Yes, it
Yeah.
certainly does.
So
And so,
so this is why it is very important to have it, because should there be an ATO audit, you've got to be able to
mm,
sort of say, look, this is our intention, and you have to have some sort of a trail to be able to substantiate
to
that this was
substantiate.
our intention.
Yeah, yeah. Because I mean, from what I know with my account is, I do say at the beginning, this is the intention of what we're going to do. I guess it sort of backs up the notion of ensuring you've got file notes as well, and there's a trail
Absolutely,
of your
absolutely. The
conversations.
file note, the emails, what sort of emails you are sending to your bank, when
Mm,
you're doing the loan, because ATO actually, if it really comes to the audit, ATO has got the power to even ask your bank, that what was the intention, what is the notes, what did you tell
mm,
them at the time of taking a loan. So all these things have to be very carefully looked at. And Cheryl, to be honest, I mean, especially for the first time developers, who have never done this development before. I mean, if you really are a seasoned developer, you are doing it, you are doing a development every year, so you obviously have a history. So if you then say that, okay, my intention is to be an investor and hold, now that has got no weight, because you've already built up a history that this is what you do, with every development. So that's not going to cut mustard with ATO. But especially if you're beginning, you don't have that type of history, and especially if you have the capacity to hold, and what I normally say to the clients is that, I mean, cut both the numbers, if you fall in this category or in that case, what you want to do, and you might find that that the money you are saving in terms of taxes, might just make it a lot more lucrative for you, especially if you are getting into it.
And so, how do we determine what's the difference between a business and a profit-making scheme? And it looks
Okay.
like one is one more so isolated, but yeah, how do we determine if we should be starting a business in development?
Okay. So basically, whether you are a profit-making scheme or a business, you see the end result, Cheryl, is still the same. You will have to pay GST. You'll have a business rules apply there, and because of that, there will be a little bit of a higher level of compliance. But a profit-making scheme is isolated. So when it might be that this is your first development, and you have never done it before. So you don't have that history of like a business, but then you still are caught with the same rules in a profit making scheme. So that is basically the ATO's way to say that even if you're not doing it frequently, even if you do it once in a blue moon, we'll still tax you as you'll have to pay GST, and the business rules will still apply.
Okay.
So
So
this is why I
basically,
say that it is important to take advice, because obviously there are complex area, there are big gray lines. It's not really cut and dry. It depends on intention, Cheryl. It depends on each individual person's individual circumstances. So it's obviously the best to take advice on this. And this is really what I say is the structuring. When we say about the project, it should not just be thought of as just the company or the tax return or an ownership structure, but onto this, that where do you fit in these three
yeah,
with what you're
yeah,
trying to do.
yeah. And so in terms of build to rent, where does GST sit?
Alrighty, so build to rent. So when you build to rent, you are more likely to be an investor. But not necessarily. Like I said, the lines are a little bit blurred here. So now give me a situation, Cheryl. So you build to rent, and for how long? How long
Oh,
you want to hold?
at least 5 to 10 years.
Okay, so if you hold for 5 years, then after 5 years, there is no GST on it anyway, because the GST is on a new property or a new house. And a definition of a new house is that something that has been constructed and it is new for 5 years. After 5 years, it's not new anymore. So the GST is not there. But that also means, Cheryl, if you had claimed any GST credits along the way in construction process or subdivision, you're required to give it back. And so in that case, there is no GST. But if you really, and so there is no GST in that case, and you probably will get your capital gains discount. But if you really are building to rent, like, and you will exit in 1 year or 2 years, then ATO still is going to can insist that yes, you have to pay GST, and you are either a business or a profit-making scheme.
Yeah.
And this is where it really comes in handy that you are really able to prove your intention. That no, this was not the case. We probably sold it. Maybe something changed.
Excellent. Well, I know we've got a few people asking about trust, discretionary trust, all sorts of
Yeah.
different trusts. Let's dive into that. Everyone's sitting there with a bated breath.
Excellent. There we go.
Excellent.
So, like I said, Cheryl, structuring, we have two parts. One is what is your nature of activity. So, in which quadrant there you or quadrant you fall in there, which will determine how your numbers are going to be added for the
Mm,
purpose of tax. And the structure will determine really, what percentage you will pay, and also asset protection. Now, the three most popular structures is a company and a family trust and a unit trust, and you can also do it in your own name. Now, a lot of time people ask me, Cheryl, in which structure I should do? What is the
mm,
structure? Now, the
mm,
thing is, it depends. There is no one size fits all. Each person's circumstances is different. Each person's project is different. Their family circumstances are different. So we really, it's sort of an horses for courses things. But let's just look at what are the pros and cons of the various structures. Now, company. Now, if you really are an investor, Cheryl, like you were saying that you are building to rent. So obviously the company is not really a good structure for that, because you will not get, the company does not get the 50% CGT discount.
mm,
So you will obviously lose out there. But company gives you really good asset protection. It has the ability to give franked dividends, so you can pass on the tax you paid in the company to the shareholders. So the company would be more suitable, Cheryl, to people who are either doing, whose nature of activity is either a business or a profit-making scheme. Uh, so because of that. And company is again not good for build to rent, is because if you really are going to do negative gear, you will not be able to transfer the losses to you to write off against other income. Though
mm.
I'm not a big fan of negative gear, because to me it's essentially trying to make a loss, to save some tax. So that's not really a good thing. Now, coming on to the family trust gets a 50% CGT discount. And you see, the biggest thing with the family trust, Cheryl, is that you can stream income to uh, members in the family who are on a lower tax bracket than you. And you're not locked into the consequences. You're not locked into any fixed percentages. You can chop and change it every year, or it's really is at the time when you have something to distribute, you can see what are the circumstances, what is the best tax effective way to distribute, and you can do that. And that really smashes your tax rate down.
Mm,
But then
mm.
again, if there are losses, then you can't distribute that losses and write off against your personal income. They are quarantined in the trust.
Yeah. And what determines family?
Okay, so the family, we specify what are the beneficiaries in the trust. So let's say if you and your spouse are the beneficiary, so that makes you a direct primary beneficiary. But it's really drafted in broad terms, but it means that your children, your parents, your siblings, and broader family, mother-in-law, sister-in-law, a lot of people are covered
Mm,
really in
mhm,
that.
mhm,
So,
mhm.
but you really don't have to distribute it to them, unless really it makes sense from a tax point of view.
And that they're
And
nice
that's
to
a big
you.
advantage, and that absolutely, and that's obviously a big advantage of the trust.
Mm,
And unit trust is a very good structure, Cheryl, for doing syndicates. I mean,
mm,
obviously in a family trust, so if you are just doing it or your family is involved, that's fine. But let's say if you're doing it with friends or with your business partners, or two or three people are getting together, putting money and doing a little bit of a syndicates and a joint venture. Now that again is a very good structure for that. Now the only downside in that structure, Cheryl, is that your units shares are fixed, which has
mm.
got to be, because all partners you need to know what those shares are. But what you can do is the units, instead of holding it in your name, you can hold a unit in name of a family trust. And that means that you still have the flexibility of transferring your portion of the income in the best tax effective way.
Mm.
And I'm not a big fan of holding the units or the shares in your own name. You see, the whole idea of when we talk of asset protection, Cheryl, is that you really are in control of everything but own nothing.
Mm.
Because anything in your personal name, whether it is a share or a unit, even though you think is $10, but when the project starts, and it gains in value, and it will be worth a lot more than that.
That's what we're hoping, anyhow.
Yeah. And obviously, when you can obviously do it in personal name, you get all the benefits except that you don't have any asset protection. You're personally liable
Mm.
for everything. Your family home could be online. And if you're doing a negative gear, then definitely you need to do it in your personal name, because otherwise you will not be able to get the benefits. And really, Cheryl, it's not a question of which structure you should do, or can you do it in one structure or can't do it in other structure. It's really a question, you can do it in any of the structures you want, but really it depends on in your particular situation and for the project, what is the smartest thing to do,
Mm.
you know and that's what
Yeah.
really comes to, or we can use a combination of above.
Mm. And again, it sort of stresses the need to be able to sit down with your accountant to sort of go, all right, this is the
Absolutely
intention of what we're going to do with this, and then
correct.
your own individual circumstances as well.
Correct, absolutely. And your intention is not what you say. It's not your word against the ATO's word, but you got to be able to sort of reasonably demonstrate your intention if it comes to that.
Yeah, great. So this is another fun bit. It's case study time. What are we looking at
Yes.
today?
All right. So now, Cheryl, now let's tell a bit of a story. Just to lighten a heavy topic. Uh, Now that's really a client. I mean, he's already set up a company, put up an offer in the company. The offer got accepted. Was just come to me for a second opinion, and 3-unit subdivision. Looked at the numbers, would have made sort of $200,000 on that. Looked pretty reasonable. And then when I spoke to him about the GST, he said, "What GST? Why
Mm.
should there be a GST? I mean, it's incredible. And I said, no, just because now the way you're doing and your intention is obviously want to do it and you want to sell it after that, and you want to start advertising once off the plan, sort of thing. So said you will lose about $62,000 in GST, which means you get only $138,000, not $200,000.
Mm.
And since you are in a company, that basically means that you will have to pay income tax on the full. You don't get any CGT discount anyway, even if it would have been applicable to you. So that basically means is that with the GST, and he was on a very high tax rate, which basically means he is the only shareholder. He would have to distribute all the money to him, and he would have ended up paying $62,000 tax on that. So of $200,000, Cheryl, he would have paid $124,000 to ATO.
Ouch.
So
Mm.
so
Mm.
literally he would have paid 62% tax on that, including income tax and GST. How crazy is that?
And
Now,
just,
when
yeah, then we
yeah,
move on to the next one. Sorry, Natin, I don't know if you can see your screen. There's a little box there that says StreamYard is sharing your screen. Can you see
yeah,
that? Can you hit the little hide button, please? To the
oh yeah, yeah, yeah.
Yeah, yeah. So that,
Sorry,
yeah, there we go. Perfect.
yeah, alrighty. So let's just
Sorry about
Oh,
that.
yeah.
There we go. Yes.
So now, obviously, what we did is then we started discussing. It was his first development. He had never done the development before. We just started understanding it. What you're trying to do,
Mm.
why you're doing this. So found out that he's not fast. He can very well hold. He just didn't know what his different options were. He was out there to make money, and then we said, all right. So what if we can now do the trust, and we can split it with his partners, and he gets onto a rent build for rent strategy, where he can sell it at a future period, and then he doesn't has to pay GST. And with a trust, he will be able to split with his spouse, who practically wasn't earning much, and
Mm-hmm.
it got his tax down drastically to about $29,000.
Mm.
So from $124,000, Cheryl, to $29,000, from 62% tax on that to 14.82% tax. It was pretty dramatic, just to show what sort of results can
Mm.
be achieved. And really, and again, this goes down to someone who's just about starting out and just in early stages of the journey and want
Mm.
to quickly do a company and go that, and what difference it can make to your bottom line, isn't it?
Yeah, I think it's really great to be able to see it in this sort of structure so that people can understand what the differences
Correct.
are,
Yeah,
and also make an informed decision as to whether actually do I really need to build to sell.
absolutely. Whether you need to build to sell or you need to build to hold, all
Mm.
those things. At the end of the day, you're just trying to wanting a best tax outcomes.
Yeah,
And
yeah.
again, like I said, each individual circumstances is different. So I just don't want to talk about some particular type of strategies, but there could be a lot of leverage, based on what your situation is and what you really are open to considering. There could be
Mm.
plenty of tax savings out there.
Yeah, great. I can see lots of questions there, and I'm mindful of the time.
Yes.
So if we're not far from the end, so let's keep going, and then we can answer some
Okay, so now
questions.
another thing, and I'll be a little bit quick on this, is again, the common thing is, Cheryl, when people are subdividing their main residence to create a better lex or to create another unit.
Mm,
Now, a lot of people are under the misconception that since their main residence is tax-free, that what they are trying to do, subdivide, will also be tax-free. That's not the case. In fact, it is your main residence that is tax-free, but if you demolish your main residence, then there is no main residence anyway, and you could be liable up for tax on the whole of it if you are
mm,
not really careful and use certain elections the correct way. And you could be liable to GST as well. So therefore, you must need seek advice. Now, I'm just quickly giving you a case study. Let's say Sam divides his PPR and creates new titles, and he can retain the existing house. So let's say, so one scenario is he sells the house and the new titles that have created to the same purchaser at the same time. Now,
mm,
in this case, the whole thing is tax free for him. You get
mm,
that? The whole thing is tax free because your capital gains arrive only just just the fact that you have done the titles doesn't create a capital gain. It is when you sell it, you
mm,
know. And since you did not build up a new house, it was still a part of your house. You just subdivided it. Your value of the house, your main residence, has gone up, and you sell it to the same person at the same time as a part of the same offer and acceptance. No CGT, no GST. How good is that?
mm, mm. Okay.
Now, second is he sells his house and the new land to a different buyer. So he sells his main residence. So obviously, then there is no tax on his main residence. But the new land that he has created,
Mm.
he will have to pay GST on that, and he will have to pay tax on that.
So CGT.
Yeah. Now another thing is no, not necessarily CGT. It could be just normal. ATO could just treat it as normal business income. It's a gray
Mm,
area. You
mm,
need to really
mm,
see where we sit under
mm,
each situation. Now, but let's say he builds a new unit on the subdivided block,
mm,
and after that, the wife thinks, "Oh, really, new house? That's fantastic. Now let's not rent it. Let's just sell our main residence and we move on to the new one." So your main residence is tax free. You live onto the main residence for a few years and then sell it. Even that comes to you tax free then.
mm.
Tax free and GST free. How good is that?
Doesn't sound bad at all.
Yeah. And there is this another case study. I don't know if we have the time to go through it or not, but
Yeah, let's go ahead.
yeah, and Rob now and Rob owns a rundown house, 700 square meters, and he creates two titles of it. But he needs to demolish the existing house, so he says, "Okay, I'll unlock fair bit of capital. Let me do that now." The difference in this case is the key point is that Rob has been owning and living in his main residence for 10 years. So there is a good chance, not 100%, but there is a good chance that in the right circumstances, we would be able to argue that is realization of capital, not so it is not business. So what Rob is doing is he's just doing whatever best value he could get out of this thing because he had decided to sell it. So then we don't pay any GST and we get a 50% discount on capital gains, and that can literally smash your taxes right down.
Mm,
But like I said, each situation is different. But then again, consider the fact that if Rob would have just bought a house and lived in it for 1 year, and he would be doing after that, totally different story.
mm,
Totally different story because it's just too quick, So that's sort of how long you have lived in the main residence dividing creates a little bit of a subtle distinction between whether you are an investor or you are into that business or a profit making scheme category.
yeah,
Make
yeah,
sense?
yes, absolutely. And just that fine difference between going, I've built it and I'm going to hold it for 12 months. Again, you need to be,
Technically speaking, if you really build it and you are very clear in your mind that just after 12 months you will sell it because you
mm,
get 50% capital gains on discount, then on a purely technical matter, you are in the business category.
mm,
Remember what I said, everyone wants to make it quick. The difference is a businessman will have a clarity when they want to sell it
mm,
or exit it, whereas an investor doesn't know. It can
yeah,
happen in 2 days'
yes,
time, it can happen in 10 years' time. Now, how is ATA going to prove it is a different matter because sometimes they'll say that we have done this data matching, we have done this search,
mm,
and
mm,
you just when you are developing, you are selling it as a house and land package, or you are advertising it all along, or whatever,
mm,
you know.
mm, mm,
But really, having your facts and figures and your notes and other things what we were talking about before, right, it really helps.
mm. Excellent.
Yeah.
All right. So we're talking about the last bit, selling overseas property. And you're absolutely right. We are a migrant nation, and a lot of people are coming from different places and they've got property overseas. What are the things that we need to be mindful of?
Okay, so one thing is a lot of people are under misconception, Cheryl. Okay, this is a property in India or in different country or in UK, so they would not be paying tax here. Absolutely
Mm,
wrong. Australia, as long as you are a tax resident here, you pay tax on your world income. Now the
mm,
chances are, if I just give the example of India, because I've helped a lot of clients from there in that situation, is they will obviously tax it there. In Australia, also, ATO expect us to work out the capital gains as per the Australian laws, and then they will just give you any credit for tax you paid in India, and the balance is expected to be paid here. And
mm,
usually it will work out that you will obviously have a tax to pay here. There'll always be a balance of tax to pay here. But if we really plan proactively, Cheryl, again, this is really important. Proactive word is very important. In a lot of cases, we can really minimize that because we can go into things like that. All right. So when did you migrate to Australia? When did you become a permanent resident of Australia? Can we then substitute the market value, you know,
mm,
rather than your cost from an Australian taxation point of view? And if we are really able to do that, we will just be able to reduce the gains as per the Australian tax significantly.
mm. And that was one of my questions when you mentioned at the start the double tax agreements. I didn't realize that excluded property.
They most of them
That's
they exclude property. If you really, I mean, if you really look at the double taxation avoidance agreements, they're all worded in a way that the long and short of it is that property will be taxed in both countries.
mm, Australia wants its piece as well, obviously.
Exactly. And look, people say that this is very unfair. Why are they paying tax or why are they paying it again?
Mm,
But
mm,
I get it. I
mm.
get it, Cheryl. But look, it is
Yeah,
what it is.
yeah. And so when people are selling property overseas and they're bringing money over to Australia,
Mhm.
what are the things that need to be considered? Is there sort of, anti-money laundering type regulations to consider as well, or reporting?
Absolutely, absolutely. But look, what will happen is that from most countries, and especially if you're transferring it from Asian countries or Southeast Asian countries, there is very there is a very rigid bureaucratic process
Mm,
in terms of how you can transfer the money overseas. A lot of forms, a lot of accountants statements and tax returns involved, and it is reported obviously to the Reserve Bank here.
mm,
And the moment you have that property sale or you have a big transfer coming in, whether it's from property or whichever, the ATO ATO will write to you. Now it might happen, not happen immediately. It might happen after 2 years, but ATO will write to you saying that you've got this $500,000 coming in on this and this date, please explain what this is for.
mm,
And if you don't, or you delay in replying to that, the ATO will just say that we think all of it is your income. And
mm.
here's $250,000 tax on it, which you must pay by that and that date.
So just be mindful if you're selling property overseas.
Absolutely. If you're selling, if you have an overseas property, and especially if you are a first generation migrant here, or if you got it through inheritance, we probably can reduce your tax. We can't
Yeah,
avoid tax, but we can probably significantly reduce your tax in some circumstances.
yeah, that's great. Great to know. All
Yeah,
right, Nitin, thank you for that. And I know we've got a few questions here. So you ready to dive into those?
absolutely. Fire away, Cheryl.
Eh, Great. All righty, let's start. Where a property is held in a discretionary trust
Mhm,
and records a profit for the year, can you
mhm.
use that profit for that year to pay extra on the investment mortgage and thus not report profit for that year?
No, because you must say what the profit is. You know, the
Mm,
profit is calculated after minusing your interest,
mm,
but your principal payment for that is cannot be deducted from the profit. So basically, what will happen is so that profit will have to be distributed to someone, and will pay tax on whatever your marginal rate is, and after that, you do what you want to do with that. I mean, ATO doesn't say that you can't distribute that profit, Cheryl, but it's really a funny thing. They will say, but if you do it, we'll charge you at tax at 49%.
mm. Hope that answered your question
Yeah.
because I didn't understand that. I'm
Now,
glad you did.
the bottom line really is that you can't.
Mm. Yeah.
So
All
you will
right.
have to distribute that money to you. You pay tax on that money, whatever your tax rate is, and then you do whatever you do with that. But you can't say that I've just transferred that money from trust to my loan account and I don't pay
Mm,
tax on that.
Okay. Got it. All righty.
Yeah.
Thank you. Next one. Can I apply consultant's cost for one property against the capital gains of another property in the one tax year? Oh,
Consultant cost for one property against, so what type of consultant cost? I mean, if it is a tax cost, then obviously you can claim it as a part of your tax return. But if it is a consultant cost in the sense that you are taking some advice for someone who's sort of managing the project for you, then no, because the capital, you see, capital gains by its very nature, Cheryl, will come into play when you sell it.
mm,
And when you sell it, then you look at the cost base and all that and deduct the costs. that point in time. So if you really are, and for that purpose, if the other project you're doing is not really finished, then there is no capital gains. It's not yet come to a stage where you'll be paying capital gains.
Mm, mm.
So
Yeah,
most
that's a
likely not, but if it probably doesn't answer the question, I mean, I'm happy to have a chat offline and go into the specifics and probably give a more targeted advice on there.
sure. Thank you. So, all right, the next one, this is more a comment than a question. Instead of distributing a profit to low income earners as a beneficiary, just pay down more on that mortgage and technically not realize the profit for the financial year. So, we're talking about the family trust.
Yes, family trust, and this was again the point, Cheryl. If you make a profit on the trust, then you have to distribute it. Period. You can't say that I paid. You see, paying a mortgage or paying a mortgage in terms of repayment of the principal, is how you use the profit.
Mm,
It doesn't reduces your profit. It is a use of the profit. So you will still have to distribute that profit to you, pay tax on that profit,
mm.
and then you do what you want to do.
Yeah, yeah. So it's a benefit of the family, and it's the other name for family trust is discretionary trust.
Correct. But what you can do, Cheryl, and it might be that sometimes you can distribute, instead of you can distribute profits to a bucket company.
Hmm.
If your tax rate is high, personal tax rate, then you can leave some profits there and uh,
Yes.
and pay tax at 26%.
There we go. The good old bucket company.
Yeah.
Excellent. Okay, next one. Um, I'm actually not sure which one this comment was directed towards. Consider my question investment and long term distribution to a family. Sorry if it's not quite 100% profit making short term development. I think that was a comment.
I
I
think it's
can't
more of
remember.
a more of a comment that they think is investment, and look, it may well be, but
Mm,
I think we've just given enough sort of education and clues into people can see where they sit. But I would
yeah.
say it's a complex area. Always take advice.
Mm. So this one's another comment. It's around the discretionary trust, and I know towards the end of last year I had to make sure I went through all my trusts to make sure that we remove any references to foreign ownership.
Yep.
And if particularly if you've set up a trust quite a while ago, I'm not sure what the implications are if you haven't done those changes at the moment. But yeah, a few of them definitely make sure your trust
Absolutely.
denies
Very,
foreign
very,
ownership.
very, very, very good question, or a very good comment. And what really it is, Cheryl, is now you might not have any foreign beneficiary in your trust. You might not even be giving
Mm,
it to any foreign beneficiary. You might not never even intend to give it to the foreign beneficiary. But if your trust does not expressly exclude, have a comment that you cannot give it to a foreign beneficiary, then what the
mm,
revenue departments of different states, New South Wales, and that's happening in other states as well, they say that just because you have not ruled out distributing it to a foreign beneficiary, we think you will. And therefore,
mm,
you will
mm.
pay the surcharge on stamp duty that foreigners will pay. And you could easily end up paying 7% more stamp duty. How
Ouch.
crazy is that?
Yeah, yeah.
Yeah.
We don't want that. For people who have not made those changes prior to the end of last year,
Yeah, they missed the
I
boat,
mean, they've missed the boat.
especially for New
Sorry,
South Wales because they legislated it.
sorry,
Yeah.
sorry for the news. Should have moved to WA. Excellent. I think that's pretty much wraps it up for our questions,
Yeah,
Natin. Thank you so much.
not
Um,
at all.
for
It was a pleasure.
for for anyone that wants to get in touch with Natin, he is offering a no obligation. Is it how long of a call? Was it 15
I
minutes?
say it's
Half
a,
an
it's
hour?
a 30 minutes call. I think that's sufficient to just understand and
Yes.
point people in the right direction. So happy to help.
Absolutely.
Yeah.
Also, his website, nevaccountants.com.au. We also have, if you'd like to make a booking, it's a Calendly. We'll also add it to the comments at the end of the Facebook post as well. But I thought that that was a fantastic presentation, very, very descriptive. I love case studies. I can't tell you enough how much it's so good to be able to also see the different structures and how it impacts on the one, the same project, and how important it is to really sit down and understand what your choices are. So,
It does, Cheryl. And look, like I've got a big background in building industry where I've been a
mm,
CFO and GM, doing all these projects and managing it for clients. And I would see what type of mistakes people do and why they did not do their due diligence on the blocks and other things. And now for the last 6 years, when I'm into public practice and advising people on the tax issues, and I'm saying to myself, geez, so that due diligence should also be there in the tax, because you could
yes.
end up making good money in a development project, but end up paying, like we said in that case study, 60% of it to the taxman.
Mm. Yeah, and that's really painful to find out at
Correct.
the very end.
Correct.
Fantastic. Thank you for sharing that and bringing that to light for a lot of us. If you don't have a property accountant, have a chat to Nitin. This is, you've got your Calendly there. We'll pop it into the Facebook group and LinkedIn comments as well. Thank you everyone for joining us. Thank you, Nitin. That was fantastic. And
Thank you,
we'll
Cheryl.
see you again.
Always fantastic to talk to developers and always fantastic to give tips on how to minimize tax.
That was full of value.
Yeah.
Have a fantastic evening. Everyone, take care of yourselves, keep safe, and we'll see you all next week on the Business of Property. Bye bye.